Hello everybody, welcome to the first video of the LLQP focused on life insurance module itself. So this is chapter 1 called the Introduction to Life Insurance. We're going to talk about some very important things in this chapter. Albeit it's a very small chapter, not so complex, but there are some very important basic elements of life insurance that you need to understand before moving forward in terms of how insurance companies operate, what they try to do, what they're trying to predict, and very important probabilities of really assessing when someone may die, and on the accident and sickness side, when someone may get injured. So here, again, nobody likes to talk about death, but unfortunately, if you're going to be in the insurance industry, it's going to be a conversation that you have on a regular basis. So we're going to talk about the risks of death really in this chapter, and we're going to really focus around a couple different probability measures of death. And the first one we're going to talk about here, the first point, is going to be what are referred to as the mortality rate. Okay, and what is the mortality rate? This is simply the probability of dying at a specific age. Okay, so within the LLQP, we're going to talk mortality again. Mortality is talking about the probability of dying at a specific age. Okay, so maybe you have a 5% chance of dying at the age of 67. Maybe you have a 45% chance of dying at the age of 82. Okay, so there's going to be a mortality chart that you can look at and understand, hey, this is my probability of my characteristics, and these can vary depending on being male, female, some different characteristics within there, but that's what a mortality rate is. Don't get this confused with a morbidity rate. Okay, morbidity or morbidity table, when you get to that, is the likelihood or the probability of you getting injured, okay, at some point in time at a specific age. Okay, so make sure we're on mortality rate here. Okay, so that's the first point that you need to kind of have in your head, or the first term that you should have in your head. The second one is just a very simple one, okay, and we've all probably have seen this before, or at least thought about it for, is your life expectancy. Okay, and so this is simply the average number of years one can expect to live from some age, okay, forward. Okay, so hey, I have 45 years life expectancy from this day forward, or maybe you have a 25, or maybe you have a 75. That's simply life expectancy, and we probably all, in some ways, have thought about how much longer do I have to live, or how long will I live. That's simply life expectancy. But again, this is important for insurance companies to understand. What is the life expectancy of somebody? What is the probability of them dying at a specific age? And now we're going to talk about the probability of death. Okay, and this is simply the statistical probability of dying before your next birthday. Okay, so maybe you have a fairly long time horizon. Maybe you're very young. Your probability of dying before your next birthday is probably very low. Maybe for 25 years old, probability of dying before your next birthday is probably less than 1%. But as you get higher and higher in age, let's say you get to 85, 86, 87, your probability of dying before your next birthday dramatically increases. And we're going to look at some charts here in a second that actually show that. Okay, and those charts that we're going to look at here right now are called mortality tables. Okay, and there should be examples, or sometimes referred to as life tables. There is an example in your book, and here this is just the format of presenting this life expectancy and the probability of death. So let's just go and look at a quick example here. And like I said, you guys have an example in your book, but let's just go to the web here and this quick. I've already brought up a website. I've just simply gone and Googled. If you just simply Google mortality table, you could get a variety of different pages. So here's a page. It's a simple website, lifeexpectancycalculators.com. We can go down through here, and we're gonna see here in the expected lifetime. So in this first chart here, we have a man. Okay, so males at the age of 0, the life expectancy, the average lifetime is approximately 75 and a half years. Okay, if we go down through here, we can see how this change is going forward, right? So if we go down and we stop this here, let's say, let's compare actually to a female. So if we scroll up here, if we come down to the females all the way down here, their life expectancy is close to 80, right? Just over 80. So we can scroll through here and we can see the expected lifetimes that one has to live. Now we can also go back and we can look actually at mortality. What's the percentage that you may die within your next birthday? And here we can see there's also going to be probably a pretty high chance that males will die sooner than females. So, you know, table 1.1, you guys refer to table 1.1 in your textbook. This will outline an example, okay, of this. So table 1.1 in the Cicero books. This will outline an example of mortality tables. Okay, so let's move next onto how we can look at some different financial impacts of death. So now we're going to go into some financial impacts of death. Okay, so these are going to be the financial impacts of death. Okay, and there's going to be a variety of different potential impacts, obviously, that you can probably interpret from someone dying, okay, within your family or a friend or really anybody that you may be advising in terms of how we may be able to equip them with the proper life insurance or accident and sickness policy to really reduce some of their risk. But here it's going to be focused on death, so we're going to be really talking about more about life insurance. And so the first one that we'll talk about is the loss of income. Okay, so obviously this is one of the biggest risks that one, especially a family, may face, is the loss of a stream of cash flows that come to them on a monthly, yearly basis in which they rely on to provide for their family, for their children, etc. So the loss of that income as death occurs needs to be replaced in some fashion for the family to continue on living the lifestyle that they have been accustomed to. So the loss of income is a really, really important factor, and as we go through the rest of the module, we're going to see different ways that we can assess how much life insurance someone needs based on their income in other areas. Okay, so this is a huge one. Pretty self-explanatory, I think, for most people to understand. Yes, if my father dies, or my mother dies, or if my wife dies, or if anybody dies, look, if they're an income provider, you know, how are we going to replace that income going forward is a very important component to understand. The second one here is the loss of a caregiver. Okay, and this may be a caregiver, and this is very important potentially now as we get into an aging population where many, children, grown children, are caring for their elderly parents, and potentially we have to address, and if they are a caregiver and they are providing that care, if they do pass away and they're not here anymore, how are they going to be replaced? Maybe we need cash flow to hire someone to replace them in the care they give. And then this also goes for children also, right? If you're going to be caring for a child, you need to understand how that's going to impact children going forward. So that's the second one. The next one is debt repayment. Okay, so again, if you have lots of debt and someone passes away, how are we going to pay off the car loan, the mortgage, all those different debts that individuals may have? It's an important thing to understand how that's going to address, and this is also addressed through many debt lenders and trying to provide protection against the death of someone who borrows money from them. Next is income tax liability. Okay, so income tax upon death. We're going to talk about this further as we go through in the tax module. Is that on death, maybe there's a huge sum of money that need to be paid on capital gains, and you have maybe some RIF money and some registered money that has not already been paid for in terms of their tax liability. This is a huge component there also. Estate creation, maybe someone wants to create a legacy. Okay, so in a estate fund or estate creation, they want to leave money behind to someone. Maybe this is, in terms of charities, education funds, etc. They may have their own intentions in terms of setting that up for their families, religious organizations, charities, etc. So they might want to address that. And the next one is a big one, and we're going to get into a couple chapters, is the business impact. Okay, if you run a small business or you have a business, what is the impact that has on the business itself? Are you a key employee? Maybe your partner needs to have some cash to buy you out in the event of death. And so these are important factors here in terms of the financial impacts of death. Now, how can we manage some of these? Okay, so risk management strategies is the next section here. Risk management strategies. They propose 4 basic risk management strategies in terms of overall risk management, not just the risk of death. One is risk avoidance. 2 is risk reduction. 3 is risk retention. And 4 is going to be risk transfer. We're going to talk about these quickly here. Risk avoidance, so it's hard to avoid death, right? Death and taxes are 2 things you probably can never avoid, but you can avoid, in general, in terms of risk management strategies, you can potentially avoid risk. Let's say if a car accident, by not getting in a car, not driving, right? You can avoid that. Risk reduction, we keep it with the car example. I could potentially reduce my risk by maybe driving the speed limit, obeying laws, ensuring my tires are pumped up, etc. I can potentially reduce some of those risks by what? Ensuring that I have proper safety mechanisms involved there within my vehicle. Risk retention, that's fine. All this is saying, number 3 here, risk retention is saying I'm going to take on the risk. If I'm involved in a car accident, or I'm involved in some sort of issue that is going to provide me with some sort of injury, that's okay. I'm going to take this on. I'm going to be able to take this risk on, and I have the financial liability that I will be able to take on it and pay that. And the last one here, this is risk transfer. This is what life insurance and insurance is all about. I'm transferring the risk, right? So if I have a risk of, let's say in terms of life insurance, about the loss of income for my family, I'm going to transfer this risk off to an insurance company to take on. Okay, so this is where insurance companies take in. They're going to say, okay, I'm going to take on the risk of your death and the liabilities that you might have going forward. Okay, so those are 4 examples of risk strategies, and that's really the essence of chapter number 1. Okay, so going forward, we're going to get into Chapter 2. We're going to start going a little bit deeper into the life insurance industry and life insurance itself.